Good afternoon, students. Welcome back to this discussion on audit. In the previous sessions, we have been discussing about the audit report, and we plan to continue with that today. So, there are certain aspects related to audit report that we'll just discuss and sort of wind up today. As regards the audit report, we were discussing about key audit matters. Okay, so in the previous session, we discussed as to what is a key audit matter, why is that required to be reported, if at all this is reported. So what all things are required to be covered therein, means how will you report this? Okay, so now continuing on that key audit matter, let's try to understand certain more aspects around it, and then we'll just also try to look at some examples. Yeah. Okay, so before we get on to that, let's do a quick recap. So key audit matters is all about some of the significant matters. Okay, and in respect of those significant matters, we discussed that there is a specific criteria which the standard talks about. And what is that criteria? So there are a few parameters which a company needs to, which the auditor needs to look at. One, the matters which are communicated to TCWG. Second, the matters which are of significance, okay, or you can say most significance in relation to the audit. Third, the matters which require significant effort from the auditor's side. Okay, in terms of the time involved, in terms of the complexity which is there. So that's why the time involved on the senior members. Yeah, so that is the criteria. So we discussed all of these criteria in more details. Further, the next point was that if at all, let's suppose there's a CAM or there are a few matters to be reported as CAM. So how do you report them? So we discussed that first of all, we need to consider in the reporting, means in the report, the reason for reporting that matter as CAM, means we will specify why such matter is getting reported as CAM. Further, how the auditor has dealt with that. Okay, so if you are saying there's a very important matter, okay, which was of quite significance during the course of audit. So how has the auditor taken care of that matter? In this case, it's all about explaining the audit procedures. Okay, yeah, it's all about audit procedures. Then, because it's a matter related to the financial statement, so somewhere this item, this particular event, this particular transaction, this particular area must be reflected in the financial statements. Yeah. So a reference to that disclosure in the financial statements will also be included so that the user can connect to the relevant part of the financial statements along with this reporting which is going in the audit report. Okay. Now, all of these aspects were around the key audit matter. Now, in relation to key audit matter, we also discussed that there's a mindset issue. Generally, it is considered as if it's a negative reporting, which is not true. Yeah, which is not true. So one should not think that if a matter is getting reported as a CAM, so there's a modification. No, there's no modification as such. Okay, so that's why one needs to be clear that key audit matter is only about some of the matters over which no negative reporting is being done. Number one. Further, another thing which gets linked to the CAM is that if let's suppose any matter is now getting reported as CAM, we should also not think that any negative reporting which is required to be done, for example, say a modification in relation to any matter. So just because we have reported that matter as a CAM doesn't mean that requirement of such reporting as modification will go away. No, that's not true. Okay. So in simple terms, we can say that this CAM should not be considered to be a substitute of any other audit requirement. Yeah. Or any other reporting requirement. Yeah. So that's how one should go about it. Okay. Clear? Now, in relation to TCWG, I think we have already talked about it earlier also, that when it comes to the TCWG, certain matters are required to be communicated to them. Now, what are those matters? They are all going to be significant matters, and therefore, any CAM which the auditor plans to report will also be communicated to TCWG. Yeah. So you may be thinking, but sir, one of the criteria of reporting under CAM is TCWG. So that doesn't mean that only those matters which we are planning to communicate to TCWG will become CAM. Okay, that's not true, because there are two more criteria. Okay, which anyways will reach out to TCWG. Yeah, because of various other reasons. But specifically on this CAM, a communication should also be made to TCWG. Why? Because they need to be aware of this. They need to understand that this is what the auditor is planning to include in the reporting. Yeah. So that's something which is considered to be important for the purposes of reporting requirements. Okay. Now, this was all about CAM. I think we have already looked at CAM in the audit report. Okay, so I'll not be getting into that once again, because we already understand that. We have already looked at that. Now what I can do is I'll just pull out a case scenario, okay, wherein we'll just try to discuss about CAM. Okay, our understanding related to CAM, we'll just try to discuss in that case. Okay, so just give me a minute. All right, so now if you look at this example, yeah, so I have just put down one example. RBJ is a listed company engaged in the business of software and is one of the largest company operating in this sector in India. Company's annual turnover, profit, all of these are given due to the nature of the business and size of the company. Operations of the company are spread out. Okay. Now, what does it mean? In size is quite big, and anyways, we are just talking about a company. Okay. Anyways, we are talking about a company. Okay. One of the largest in the particular sector. Outside India, companies focusing more on US and European markets, and the company has been able to establish its good reputation. Okay. During the course of audit, as happened, the audit team spends significant time on audit of revenue, whether it is planning, execution, conclusion. Audit team for this engagement is generally very big. Of course, depending on the size of the company, audit team will be appropriately considered. Team of approximately 70 to 80 members. Company's contracts with its various customers are quite complicated. Efforts towards audit of revenue also involve significant involvement of senior members of the audit team, including the audit partner. After the completion of audit for the year ended 31st March 19, audit partner was discussing the significant matters with the management. wherein he also communicated to the management that he plans to include revenue recognition as a CAM. Management got surprised to understand about this reporting, okay, and did not agree with the revenue recognition to be shown as CAM. Why? Because as per the management, auditors didn't have any modification, and such a matter getting reported as CAM would not go down well with various stakeholders. Stakeholders will not like something like this getting reported, and revenue anyways happens to be a very, very important area. Yeah, for any company, revenue is a significant item. Okay, so as a result, what will happen? So if this is reported, so what will happen? This would significantly impact financial position of the company in the market. So it's all about reputation. Huh? So that's what the company is considering. Okay, but auditors were not able to convince the management in respect of this point. Okay, so somehow the point of view of the management, whatever is there. Okay, now auditors have not been able to explain their point well. Okay, they have not been able to convince the management as around the reporting requirement we are discussing. So in this case, there are a couple of questions for you. That given the situation, if you are the audit partner, which all areas you will consider for reporting as CAM and why? Okay, so forget about what this auditor has done. In this case, do you think there is any matter for reporting as CAM and why? Okay, over to you. If you think there is any matter which needs to be reported as CAM, number one, and why do you think so? Why is that required to be reported? Over to you, quickly. Yes, anyone? Quickly. In this case, what do you think about CAM? Is there anything for CAM, or you believe no, there's nothing in the given situation for CAM reporting? Yeah. So tell me, do we have anything to be reported as CAM? Yes or no, and why? Over to you quickly. All right, so let's try to understand. If you look at this revenue, okay, so now this revenue, I think something which Shreya has also mentioned, okay, matters which involve significant involvement. So if you look at this particular area, revenue, this has required during the year significant involvement of the audit team. And amongst the audit team, it's the senior members of the audit team who are involved. Okay. Therefore, one of the criterias for reporting a matter as CAM is fulfilled anyways. Yeah. Secondly, if you look at some more considerations, now what are those? The other point is around the nature of the contracts. So it says contracts with the customers are quite complicated, different. Can we say that revenue for this company or for any company would be a significant amount? Tell me, can we say that? Would be a significant amount? Shreya says yes, and I think Dhanush also has a point. So if you look at all of those criterias, revenue is a significant area. And we have also discussed in our previous sessions that the revenue is considered to be a presumed significant risk as well as fraud risk. So anyways, the attention of the auditor on such a matter will always be required. Yes or no? That anyways will be required. Without which it will not be possible to get on to the audit procedures around this area. Correct. So all the criteria, if you look at this particular revenue, will generally be met in respect of the companies. But over here, considering the nature of the agreements, considering the involvement of the audit team during the course of audit, this clearly happens to be a matter to be reported as CAM. Correct? Yeah. That's why if the management has a contention, that is wrong. So what should the auditor do? Auditor should report this as CAM. And the requirements which are attached to the reporting of CAM needs to be taken care of. Okay. Everyone clear? Yeah. So if you want, we can also go through the audit report once again. Okay, any of the audit report if you want, I can just flip through that once again. Tell me quickly. Okay, or maybe what I can do is I've got this IT company only. Yeah, so for the purposes of our understanding, we can just flip through that once. Yeah. Okay, so now given scenario that we discussed was by chance for an IT company. Correct? IT company which is into software. So let's look at one audit report. Okay, again, I'm just trying to establish the linkage to the real audit report. Okay, so this is the software company. So in this case, let's try to understand as to which all matters have been reported by the company. Okay, and you will find that the company is reporting revenue recognition. See, as we discussed that revenue recognition will generally be meeting the criteria of CAM. Particularly for such type of companies, particularly for companies having such type of contracts. Yeah, it would become all the more important to report such matters as CAM. Or you can say all the more difficult for the auditor not to consider this matter as CAM. Yes or no? Yeah. Now, in this case, if we look at CAM, okay, so in this case, if we look at CAM, so what's the matter? Matter is revenue recognition, but they have specified as to which all types of contracts they have considered in relation to revenue recognition. So this again can be considered by the auditor. So it's not that if the revenue recognition is considered, so everything around revenue needs to be taken. No. Maybe the auditor has picked up any specific assertion related to a particular area. Yeah, maybe the auditor says that cutoff was one area and not the remaining assertions. Yeah, so this will again vary from engagement to engagement. This again needs to be evaluated. So one should not think that if one area is there, that needs to be covered in entirety. That needs to be thought through first of all. Whether the entire area is a CAM or only a part of that area is a CAM. So that's how you will go about it. Okay. Yeah. Now, in this case, we can also look at the reporting requirement and what all things have been reported by the auditor. So it says company engages in fixed price contracts wherein the revenue is recognized using percentage of completion method. Yeah. Then he says we identified revenue recognition where the percentage completion is used as a key audit matter since. So he's trying to explain why it is getting reported as CAM. So he's saying there is an inherent risk, presumed fraud risk around the accuracy and existence of revenue recognized, considering the customized and complex nature of these contracts. Okay, and also considering that significant inputs of IT systems are required. Yeah. Then application of the accounting standard is complex. So this is about Ind AS. So they are saying that such an accounting standard requirement is complex, involves number of key judgments, estimates. Yeah. Then it says these contracts may also involve onerous obligations. At the year end, significant amount of work in progress are recognized. Okay, so these are some of the factors which the auditor has considered for reporting this matter as CAM. Now, let's talk about the audit procedures. Now, in this case, see, it is okay that the auditor is considering this to be a key audit matter. But now auditor has a problem in hand. What is the problem in hand? Because he has highlighted this matter to be a critical one, he needs to now explain how he has taken care of this. Okay. If there is no modification, if everything has been fine around this particular matter. Yeah. So something the auditor would have done. Yeah. So that is now required to be explained here. Okay. So now in this case, auditor is first of all saying that I have obtained an understanding of the systems, processes, controls. Now you may be thinking that, sir, is this an audit procedure? Tell me, do you think it's an audit procedure? Tell me, over to you. Yes, over to you. Do you think it's an audit procedure? Shreya says yes. What about others? What about others? I think it's a very, very simple question for you to answer quickly. Tanu is also saying yes. What about others? Almaz is also saying yes. Sunil is saying yes. Gokul is asking this. Yeah? Okay. See, when you go ask for questions, when you try to obtain the understanding, it's a part of the audit process. Yes or no? And all of these requirements are going to help the auditor in forming the conclusion. Yeah, so these are all evidences for the purposes of the audit. So that's why you should not think that if you are just obtaining an understanding, you are not doing anything. No, it's also an audit procedure. Okay, it's also an audit procedure. Clear? Then he says involvement of our IT specialists. So where were the IT specialists required? So at one place when the auditor is highlighting that significant inputs of IT systems are used by the company, and that is one of the reasons I am considering this to be a CAM. So now the auditor needs to justify the work around those significant inputs of the IT systems. Yes or no? Yeah. So he needs to justify that. So how will that be done? IT specialists will have to be engaged. Correct? So can the auditor say that he has got that competency? Not necessarily. And not in most of the cases. Yeah. So now, Auditor has assessed the IT environment in which the businesses operate. He has tested the IT controls. So it's about testing of controls. Okay. Tested the controls pertaining to allocation of resources, budgeting systems. Further, he's saying tested on a random sampling basis controls related to estimation of contract costs. Okay. Then he's saying we have tested revenue recognized in accordance with the revenue recognition accounting standard, including evaluated the identification of performance obligations and transaction price. For testing the company's computation of estimation of contract cost, we assess the estimates of cost to complete were reviewed, approved by the management during the year. Okay. Performed a retrospective analysis of costs, estimated costs, assessed the appropriateness of work in progress, inspected the underlying documents, performed analytics to determine the reasonableness of contract costs. Okay. Yeah. Clear? Everyone clear so far? Yeah. So this was all about CAM. So if you have any questions, any doubts, please let me know. Yeah. So this was all about CAM that we had. Okay. No questions? All right. So now let's move further. Yeah. So now we will be discussing about the auditing standard which is related to comparative information, corresponding figures, comparative financial statements. Okay. Now let's try to understand some of the terms which are involved here. Then of course we'll try to look at the audit requirements in this case. Now in this case, we need to understand what is this comparative information, yeah, and what are the corresponding figures. See, there are two different broad approaches for auditors' responsibilities. One is the corresponding figure, second is the comparative. Yeah, that will again depend on the requirement. For the corresponding figures, auditor's opinion on the financial statements refers to the current period only. Whereas for the comparative financial statements, auditor's opinion refers to each period. Now, what does it mean? Say, for example, in the financial statements, you have reported 24, 25, 23, 24. Okay, so this 23, 24, what do you call it as? Comparative. This is comparative. Yeah. So when the financial statements are audited, so the entire statement, entire set is considered as audited. So that's why, yeah, auditor's opinion which will go out, that refers to financial statements as a whole. Yes or no? Now, auditor shall determine whether the financial statements include comparative information required by the applicable framework. Yeah. And what will the auditor do? So he needs to evaluate whether comparative information agrees with the amounts and other disclosures presented in the prior period, and accounting policies reflected in comparative information are consistent with those applied in the current period. If there are some changes in the accounting policies, appropriate adjustments have been made, the required disclosures have been included in the financial statements. Okay, now in this case, let's try to understand the audit procedure first of all, and then we'll come back to this requirement. Okay, so let me just go to one working file. So what is it that the auditor will get on to? This comparative information in terms of the audit requirements. Let's understand that. So let's suppose we are looking at financial statements for 24-25. Okay, so in the financial statements, there will be two columns, 24-25 and 23-24. Correct? So now this 23-24 is what you call as comparative. Okay, so this is what you call as comparative. Now in the comparative, the numbers that are reported by the management. Okay, in the current year, you are calling it as comparative, but last year, for which financial year company would have prepared the financial statements? Can you tell me? During the last year, what would have been the financial year for which the company would have prepared the financial statements? Tell me quickly, over to you. Yes, quickly. What would have been the period? Dhanush, and I'll come to your query slightly later. Okay. Shreya, Tanu, they are saying for 23-24. So that means if you look at the financial statements of 23-24, which are audited, yes or no? Yeah, so if you look at the audited financial statements, if you look at the audited financial statements of 23-24, so in this audited set, all of these numbers would have been there. Correct? All of these numbers would have been covered. Now, as an auditor, what do you do? As an auditor, when you look at the comparative, you need to ensure that all of these numbers which are going out in the comparative, they are tying, or you can say all of these numbers which are going out in comparative, they are tying to the previous audited set. Yes or no? Yeah. Further, another point which is very important is about the accounting policies. Okay, so if you look at 23-24, company would have considered some accounting policies, yeah, which would have been disclosed in the financial statements also. Correct? Now, all of those accounting policies which were there in the previous year should also be carried forward, kind of. So now it's very important that the consistency in those policies is there. Because if, let's suppose, during the year, means during the current year, if some numbers are reported, okay, let's pick up this line item. So if let's suppose basis of last year, why? Because the policy of last year and the basis of current year means the policy for current year are different. So do you think these comparatives will make any sense? Tell me. Do you think these comparatives will make much of a sense? What do you think? Tell me quickly. Shreya, Tanu, they are saying no. So which means this aspect around the policy in terms of its consistency is very important. Okay. Yeah. Now, moving further on this. Now, these are some of the procedures we have discussed we need to do. Let's suppose if the auditor becomes aware of a possible material misstatement. So we are talking about possible material misstatement in the comparative information. Okay. Auditor shall perform such additional audit procedures as are necessary in the circumstances to obtain sufficient appropriate audit evidence. Now the auditor should not be thinking that because it's the comparative year or it's the data related to comparative year, so that's why I don't need to check this. I don't need to perform procedures for this. That will be incorrect. Okay. Further, auditor will also request written representation for all the periods referred to in the auditor's opinion. Now, let's try to understand around the corresponding figures. Auditor's opinion shall not refer to the corresponding figures except in the following circumstances. If the auditor's report on the prior period as previously issued included a qualified opinion, let's suppose there was a qualification in the previous year, disclaimer, adverse. Okay. If there was a modification, then this needs to be looked at. If the auditor obtains evidence that a material misstatement existed in prior period financial statements on which unmodified opinion was mistakenly issued, obviously it will be a mistake. Yeah. Third, the financial statements that you are looking at, you find that the prior period financial financial statements or such financial statements are not audited. Okay, so they are not audited. Clear? All right, so now, see, this was about some of the requirements related to comparative, corresponding. Now, moving on to the next aspect, and that is about audit of branch offices. Important concept, I would say. Also, in the context of today's scenarios, very, very important concept. So now, in this case, there are few terms that we need to understand first of all. Okay. So let's try to understand all of those terms and then we'll get on to the audit requirements. Now, we are talking about a branch office. I'm sure you must be aware of the branches. Okay. But let's still have a discussion on how the branches work. So let's suppose there is a company PQR Limited. Yeah, it has a branch and a head office. So let's suppose this is the head office. And let's suppose it has got three branches. Branch 1, branch 2, branch 3. Now, if the financial statements of this company are required to be prepared, so can you tell me what all requirements you may have to consider given the structure that we have? Over to you. Any thoughts? Given the structure that we are discussing, what do you think would be the audit requirements one may need to look at, one may need to consider? Quickly. What are some of those audit requirements one needs to consider? Yes? Okay, so let's try to understand. Yeah? When it comes to the company having branches, it will also have a head office. Yeah, it will also have a head office. Or you can say a corporate office. Correct. When the financial statements of this company will be prepared, so what will happen? All of these will be included. Yes or no? Because all of these head office, branch, all of these branches, if you put them together, that is what make the company. Yeah, that's the company you have. Correct? Now, generally in such a structure, head office has got a responsibility. What is the responsibility? Head offices are required to ensure that the financial statements are prepared and on time. Okay, generally that's the responsibility you see on part of head office or the corporate office. This task you can say is assigned to head office. So therefore, what will the head office do? Therefore, head office will have to coordinate with the branches. We'll have to obtain the data. We'll have to obtain the trial balances of various branches and consolidate all of that to prepare the financial statements of the company. Yes or no? Yeah, so that's how it will be done. Generally, what will happen is corporate office will have its financial statements, branches will have their financial statements. See, if you look at some of the large companies wherein the accounting is decentralized, okay, you'll see this mechanism. If you look at a lot of PSUs, banks, they work on this structure. So the head office, corporate office will prepare its financial statements, trial balance. Various branches will prepare their trial balance, which will then be consolidated at the head office level. Who will do that? Head office will do that. Head office will do that. Okay. Now, this was all about the management function. Or you can say this was all about preparation of financial statements that we have discussed so far. Yes or no? But we need to understand the audit requirements. See, in these type of structures, if you look at the PSUs, if you look at the banks, okay, again, very commonly seen that the auditor for head office, auditor for the head office is different and the auditor for all of these branches will also be different. Now, one auditor may be handling 2 or more branches. That's possible, but I'm saying not all. Okay. So you can say there will be one auditor who will audit the books of head office, one who will audit the books of branch, one who will audit the books of branch 2, one who will audit the books of branch 3. Now the question arises that when the consolidation will be done by the head office, then who will audit that set or the financial statements of the company? So for individual unit we have understood, but there has to be an auditor who will audit the financial statements of the company or not? Tell me. Yes. So whose responsibility will that be? That will be the responsibility of auditor 1. So he will be auditing the head office as well as consolidated version. Why? Because that's the requirement of the company. Okay, that's the requirement of the company. Now, in this case, let's understand the terminologies. See, this auditor of head office or branch office is what you call as principal auditor. Okay, so this is called as principal auditor. Auditors of branches are what you call as other auditors or component auditors. They are the component of a company. Yeah. So all of these are what? Components. So for every component, or you can say for components, there will be different auditors, or the auditors of the component will be called as component auditor. Now, is it necessary that the auditor of head office and component will be different? Not necessarily. But as we discussed that generally these structures you find in case of government organizations, PSUs, banks. So therein you will have this, yeah, that all of these auditors are different, or at least the one for the branch and the corporate office are different. Yeah. So what we have discussed so far is all about some of the terms. Now, let's get on to the requirements related to audit. Okay, so the component we have discussed as to what is a component and what do you call the auditor of head office? What do you call the auditor of component? Yeah. Now an auditing standard will be required to be applied by the auditor. So now we are talking about the principal auditor. See, the principal auditor will have two responsibilities. One, to audit the financial statements of head office. Correct. Second, to audit the consolidated version. Yes or no? Yes or no? Now, for this audit of consolidated version, some of the important requirements, or you can say some of the requirements which become important for the auditor. Let's try to understand that. So let me just go back to the structure, and therein we'll just try to understand some of those requirements. If let's suppose branches are audited by different auditors, okay, so does it mean that the principal auditor can also go and audit those branches again? Tell me. Tell me. What do you think? Shreya says no. Otherwise, it will be a duplication inefficiency. Correct? But let's try to understand the situation that the financial statements of the company that will be prepared. So this is the financial statement of the company. It will have the financial information of branches which are audited by another auditor. So how will the principal auditor get the comfort on these numbers? Yes or no? How will he get the comfort on these numbers? Because these numbers are audited by a different auditor. They are audited, but audited by a different auditor. So in this case, responsibility of the principal auditor is what? To obtain the audit report from these components. In relation to the branches or the data of branches, which will form part of this consolidated version, principal auditor needs to obtain audit reports of these branches. Yeah, for which scope in relation to the branches, any focus areas in relation to the audit of these branches, means what are going to be the significant risk area, yeah, and at times the materiality for a particular branch, understanding of these branches, if there are any observations related to these branches, if there are any past years observations related to these branches, all of these will be looked at by the principal auditor. But does it mean that he will go and check that for the branches? No, he will get it done from the component auditors. He will get it done from the component auditors, and whatever component auditors will provide him, means their reports, that will be good enough for the principal auditor. So he will be relying on the reports of component auditors in this case. Yeah. So there's an auditing standard SA 600 which deals with this. Yeah. So all of these points that we have just discussed, yeah, so they become relevant in the context of audit of a company, yeah, or you can say audit of branches and head office. Now, let's try to understand some more points around this. So as per this auditing standard, principal auditor should ordinarily perform the following procedures. advise the other auditor. Who is the other auditor? Component auditor. Of the use that is to be made of the other auditor's work and report, and make sufficient arrangements for coordination of their efforts at the planning stage of the audit. Principal auditor would inform the other auditor of matters such as if there is matter requiring special consideration, procedures for the identification of intercompany transactions that may require disclosure, and the timelines. For the audit, there has to be a timeline. So only when the principal will wrap up the audit, parent will be able to wrap up. Why? Because parent will always remain dependent on the principal. Why? Because till the time principal has not completed, can the parent complete the audit and issue the audit report? Not possible. Yeah, because in a way, part of his audit is completed by the component auditor only. Correct? Tanu is asking, sir, क्या ऑडिटर एक ही ऑडिट फर्म के होते हैं या किसी भी फर्म? या सो एज वी डिस्कस्ड यू कैन हैव सेम ऑडिटर्स, generally not, generally they belong to different firms. Okay, yeah, but at times some of the branches could be audited by one auditor, but of course not all. Okay, not all. That is very very important for you to understand. And just look at the banks. Our banks have got so many branches. For one auditor to audit all of those branches is not possible. Okay. Then, principal auditor also needs to advise the other auditor of significant accounting, auditing, reporting requirements, and obtain representation as to compliance with them. Okay. Now, principal auditor might discuss with the component auditor what audit procedures applied. Okay, he may ask for a review of written summary of other auditors procedures, any findings of the component auditor. Principal auditor may also want to visit the other auditor. Okay, so again, depending on the matter, situation, the type of branch, if the principal auditor wants to go meet the other auditor, component auditor, he can do that. Yeah. So all of these vary from engagement to engagement. This knowledge may have been enhanced from the review of previous audit work of the other auditor. Obviously. Yes or no? Obviously. Yeah. So now what we will do is we will look at one example. Okay, so to get some more clarity around this, just give me a minute. Okay. CA Dicky Yadav is auditor of a company having 4 branches. 4 branches are audited by another auditor, CA Yamini. Okay. A report in respect of accounts of branches examined by her have already been sent to the company auditor. Company auditor means auditor of the head office. During the course of audit, CA Dicky asks the branch auditor to share with her summary of audit procedures and findings in respect of accounts of branches examined. But CA Yamini doesn't like this. She feels it's an encroachment of her domain. Means CA Yamini is thinking that why the principal auditor wants a summary of the audit procedures. Okay, it's not relevant because I'm doing the audit, I'm providing the audit report to the principal auditor, and that should be good enough for the principal auditor. Principal auditor should not get into what all procedures I have performed or the component auditor have performed. So in this case, your thought process is required. So what do you think about it? Over to you. What do you think about it? How should this situation be dealt by the auditor? Means the principal auditor. Yes, quickly. If let's suppose you happen to be the principal auditor, how will you deal with this? What are your views? तनु सेज एसबीआई के तो इतने सारे ब्रांच हैं तो उसका ऑडिट कैसे होता होगा स्टेट वाइज या ऑल ओवर सो again it's a coordination, it's an effort. Yeah, a lot of auditors are required to be appointed and they coordinate with the parent, with the head office. Gokul says, sir, in the given example, principal auditor is right. Okay, so now if he is right, so what needs to be done? How do we settle this? Quickly. So what should be done in this scenario? How do you settle this? Over to you quickly. All right, so let's look at the solution. I think some more responses I have received. Gokul says CA Yamini will have to share the summary because if the principal auditor requires something, okay, which is only about getting an understanding and a summary, he's not asking for all the audit procedures or the work papers. Okay, so in this case, how do you handle this? Principal auditor might discuss with the component auditor the other audit procedures or review of certain summary of procedures and findings which may be in the form of a completed questionnaire or checklist. Such a review of audit procedures and the findings can be undertaken if the principal auditor feels that it is necessary to apply such procedures. Why? Because for the principal auditor to obtain sufficient appropriate audit evidence as around the company will require some level of comfort on these branches also. Yes or no? Yeah. So this thought of CA Yamini, it's an encroachment of domain of another auditor. This is not appropriate. Yeah. She should support, and that's how it should go about it. Okay. Clear on this? All right. So any questions, any doubts? Okay, Tanu is saying Yamini thought this is thought of Yamini was not right. She needs to report. Yes, that's correct. Okay, then I think Shreya is clear on this. All right. So any questions? If you have, please let me know because then I think we can take a break. Yeah. Any questions? No? All right. So let's take a break. Huh? Altaf, let's take a break. Huh? Okay, so let's continue. Okay, so the next we need to discuss is the joint audit. Okay, so we talked about the branch, we talked about the audit of a branch. Now there's another concept which is called as joint audit. Now what is a joint audit? Let's try to understand this with the help of a small example, and then we'll get on to some of the detailed requirements here. See, there is a company MNO Limited. Okay, and now let's suppose it's a large company. It has got a lot of branches. Uh, its operations are quite spread out, and company doesn't want only one auditor for audit of its financial statements. Why? Because company believes that if it will have more than one doesn't mean the audit team size has to be more than one person. Means instead of one firm of chartered accountants, company wants it should have, say for example, two firm of chartered accountants. So let's suppose this is firm 1, this is firm 2. Now, why does the company wants this? Company believes efficiency will increase. Okay, if there are matters, so there can be a deliberation, better decision take place. Instead of one auditor, if you'll have two, you can just always have some better clarity as around some of the things in relation to the financial statements. So that's the thought process. Now, in this case, let's understand as to how the audit will function. We are looking at audit of financial statements, correct? So the financial statements of this company are required to be audited. Yes or no? So if let's suppose there are two firms, so we are not saying only two persons, we are saying two audit partners bringing their separate audit teams. What will they do? They will audit the financial statements. Now this financial statement is only one. Yes or no? Now, when this financial statement of a company is audited by two firms, that is what you call as joint audit. Means they will audit this jointly. They will audit this jointly. Okay. Now, joint audit basically implies pooling together. One, resources. Second, expertise. Wherein you have more than one firm of chartered accountants, which is the auditor. Okay. In this case, does it mean that the financial statements will have to be audited twice? Means by firm 1 and firm 2? No. Because if that is done, then it will lead to a duplicacy. And objective was not to get into a duplicacy. Objective was to get into an efficiency. So how do you achieve that? If let's suppose for the audit of financial statements, work is divided amongst these two firms. Yeah. So when the audit will be performed, some of the areas will be defined as to which auditor will audit what. Okay. Yeah. So that's how we can say there will be a sharing of total work and there will not be any duplicacy. Clear? Now, This joint audit, whenever this is conducted, will always have certain reasons. The management will always have some reasons as to why they want to go about such joint audit. Correct. So let's try to understand some of the reasons and what are going to be the benefits. And every time we should not think that it will only lead to benefits. There can always be some disadvantages. So we'll talk about all of them. Okay. Now, what are going to be the advantages? What are going to be the disadvantages? So let's discuss those. Sharing of expertise, no doubt, because now you have two experts in a way, correct? And therefore, if there is any matter, if there are significant matters, a mutual consultation can be done. You can reach better conclusions. As we discussed, financial statements will not be fully audited by both of them. Work will be divided. So that's why for one firm, workload is reduced. Yes or no? So if the workload is reduced, obviously you can expect better quality. Correct. And if the quality will be better, so obviously you can say it's an improved service to the client. Yes. Then, if you look at some of the companies, this work can be spread, or you can say divided, using the expertise of local firms. Okay, for example, you can say that this firm, sort of specializes in a particular area. So that's why those areas in which this firm specializes will be assigned to this. Okay. So you can say, again, depending on the specialization, experience, expertise, this allocation of work can be done. Or at least the advantage of that firm can be there as far as experience of such industry is concerned. Okay. Now, generally you will also expect lower costs, lower staff development costs because of this. Further, another very important point. See, now you have engaged two consultants. Yes or no? In a way, auditor is also consultant in a way, or a service provider. And the service provider is required to audit the financial statements. Okay. So when you have two persons doing a job which has got same objective, so obviously they will want to perform better than the other. So that sort of healthy competition can always be expected in such a scenario. Correct? Yeah. Now, what are the disadvantages? So as we discussed, it's not that you'll always have advantages. Some of the disadvantages are also there. Now, what are those? Of course, one is the fees. So now the fees which would have gone to only one firm is now divided amongst two. Correct? If you look at it from the perspective of auditor, if you look at it from the perspective of company, it may happen that now because there are two auditors, so that's why total cost has increased. Okay. Now, because there are two firms, their mindset could be different. And there could be a psychological problem where firms of different standing. So let's suppose there's a large firm and the other one is not a large firm. So obviously some sort of complexity could be there. Yeah. And which may lead to problems of coordination, because the coordination is very important. So when you work as a team, only then you get into the efficiency. If let's suppose there's a complexity, okay, superiority complexity, okay, mindset is an issue. So therein what will happen? Coordination problem will be there that will affect the overall project, correct? Next, see, even though there will be a division of work in this case, why? Because firm A will one will know as to what is required to be done, firm 2 will know as to what is required to be done, but still some of the areas will always be common. Why? Because the eventual objective is same, audit of financial statement. So some of the common areas will always be there, which can be ignored because one firm may think other is doing that, other firm may think uh, the other one is doing that. Okay, so therefore these are some of the problems which get attached to it. So everything will have some pros or cons, correct? Now, as regards this process of joint audit, now let's try to understand as to how this process will work. Now, in this case, even though we look at some of these points as around the process, but please remember that this process will not be any different from any other audit. What do I mean by this? It means that eventually audit has to be performed. Now, instead of one, two firms are going to audit. Dhanush is asking advantages, disadvantages. Yes, disadvantages are the ones that we just discussed. Tanu is asking, sir, in this case, who has the authority to sign? So in this case, because both of them are engaged, so that's why both of them will have to sign. Okay, so they will issue their audit reports and we'll talk about that also. Now, let's get into this process as to how does it work. Engagement partner and other key members from each of the joint auditors, they should get into audit planning first of all. Because like any audit, this audit will also have to be performed. And for any audit, what are the requirements? What is the first step? Audit planning. Yeah. Now, in case of a planning, you can't say that firm 1 will not be knowing what firm 2 is doing. Why? Because it's a joint effort. So that's why this plan has to be a joint one. They need to have a clarity as to what is doing what and how. Only then they will be able to get the desired objective. Yes or no? Then the joint auditors who are there, they should jointly establish overall audit strategy. Before the commencement of the audit, if let's suppose they are doing their planning separately, let's suppose both of them are sitting in their offices doing their audit planning, what should they do? They should come together, meet, discuss, and work on a joint audit plan. Okay, in such a joint audit plan, what do they do? Identify the division of audit areas as well as common audit areas, means over which then both need to work upon. Next, ascertain the reporting objectives. Consider and communicate amongst all joint auditors the factors that are significant in directing the engagement team's efforts. consider the results of preliminary engagement activities. Okay, which is more about the planning only. Yeah. Ascertain the nature, timing, extent of resources which will be required. So all of these things are what? They are nothing but the working towards the audit planning. Correct? Further, each of the joint auditors should consider and assess risk of material misstatement. Again, a part of audit planning only. They should discuss, document the nature, timing, extent of audit procedures. Obviously, because in relation to the audit, documentation is of paramount importance. So this will have to be done. Yeah. The engagement letter which they obtain, that will be common. Representation letter that they obtain, that will be common. Okay. So the work allocation document. So once they plan everything, they would always be working on the work allocation. Correct? So in such a case, what do they need to do? They need to document it. They need to agree upon that. And that needs to be signed off by both the auditors so that later on there is no confusion as around the work allocation. And the same thing needs to be communicated to TCWG. Okay. Moving further. Now, in respect of the audit work divided amongst the joint auditors, each joint auditor shall be responsible only for the work allocated to such joint auditor. That's why we had this disadvantage. Uncertainty about the liability for the work done. If let's suppose in an engagement, let's suppose there's an engagement. Okay, in this engagement, 20 jobs were required. Okay, let's suppose 10 jobs have been taken up by firm A. 9 jobs have been taken up by firm B. So they planned well, everything they did well. What if one job is missed out? So the overall objective may get defeated. Yes or no? I'm saying job means one of the activities, one of the areas, or anything related to the audit. Yeah. So that is only possible when this planning will be done in an appropriate manner and in a joint manner. When they work together. Okay. Yeah. That's very, very important. Otherwise, all of these problems may arise. So all the joint auditors, now joint auditors will not necessarily be only two. They can always be more. For example, if you look at some of these PSUs, okay, their auditors are 3 or 4 at times. Three means 3 firms, 4 firms. All the joint auditors shall be jointly and severally responsible for. Now, what are those areas for which they will be jointly responsible? Let's understand that. Audit work which is not divided. Obviously, yeah, something which is about the common areas. Decision taken by the joint auditors under audit planning in respect of common areas. Matters which are brought to the notice of joint auditors by any one of them, and there is an agreement by the amongst the joint auditors on such matters. okay, which can impact the financial statements, because eventually to opine on the financial statements will be the responsibility of both. So when they issue the audit report, they will not be saying that I am issuing audit report on 4 areas or 5 areas. They will have to issue the audit report on complete financial statements, depending on the scope of work that they had. Yeah. Examining that financial statements comply with requirements of relevant statutes. Presentation and disclosure requirements. Ensuring that audit report complies with the relevant requirements. Okay, so all of these things are the ones over which joint auditor will remain responsible. Okay, now in this case, another point which is important for you to look at, just give me a minute. Let me just go to that relevant document, relevant portion. Yeah, so just give me a minute. In case a joint auditor comes across matters which are relevant to areas of responsibility of other joint auditors and which also deserve their attention or which require disclosure, discussion, application of judgment by other joint auditors. So the said joint auditor shall communicate the same to all joint auditors. Further, please remember, I think this is also one of your query. Joint auditors are required to issue common audit report. However, where the joint auditors are in disagreement with regard to the opinion or any matters to be covered by the audit report, they shall express their opinion in separate audit report. In such circumstances, what will happen? Audit report issued by joint auditors shall make a reference to each other's audit report. So that's how reports are issued by the joint auditor. Okay. All right. So I think there are some reporting requirements. If you remember, there is a section of the audit report that we discussed, which talks about reporting requirements in relation to some laws and regulations. Remember the part that we discussed? Yeah. Remember? Yeah. So in relation to that part of the audit report, we have had some discussions already. But there were a couple of sections we discussed that will pick up slightly later. One was the IFC and the other one was in relation to the CARO. Okay, so now this CARO and IFC, I'm just still parking that for some time. Okay, so I'll come to that part slightly later. So what we can now do is we can just look at one case scenario. On the basis of our discussion that we have had so far, let's look at one case scenario. Okay, and then of course what we will do is then we'll go back to the other legal reporting requirements which are there in the audit report, wherein we'll pick up all of these IFCs, CARO, all of these requirements. Yeah. Okay, so let's look at this question now. Messrs. AB and Company is a firm of chartered accountants based in Mumbai. Okay, so it's a firm based in Mumbai. Mr. A, Mr. B, they are the partners of the firm. Firm is engaged in various assignments, including audits. Okay, so they are doing audits. Audits over here, you can say, is the statutory audit means the audit of financial statements. Partners are taking a summary of their work in order to prepare themselves to finalize the audit and issue the audit report to various clients. So I think field work seems to have got completed. So there are certain clients for which the finalization is going on. You are requested to go through the following and answer the questions that follow. During the audit of Messrs. Persistent and Company, Mr. A found that firm has changed the method of depreciation from WDV to SLM, but has not given the retrospective effect. Mr. A has calculated the difference of depreciation, but Messrs. Persistent and Company has stated they don't want to change the financial statements, and if the auditor persists, they may give the effect in the next financial year. Okay. Further, during the audit of Messrs. Dubious Brothers, Mr. B, so now it's a different client and there's a different audit partner, Mr. B. Mr. B observed that the firm had a very large amount of cash sales and there were no details of customers to whom the sales were made. Okay, so maybe they are not maintaining that details. Something that you see in case of retail outlets also, okay, or the companies which are into the retail business. Okay. Further, the cash generated was not even deposited into the bank regularly. So the company seems to be keeping cash. When Mr. B asked the firm to give him an opportunity to count cash, firm means Dubious Brothers. Okay, so Mr. B wanted to do the cash physical verification. So the manager of Dubious Brothers, manager said cash is with the owner and it cannot be made available to the auditor for checking purposes. So auditors were refused that you can't physically verify that. Manager also declined to give an opportunity for stock verification. So I think auditor also wanted to do physical verification of the inventory. Even that was denied. Because that's about the second client, Dubious Brothers. Now third, so there is another client, third one, Honest and Associates. During its audit, Mr. A came to know that the firm has changed its method of valuation of inventory. This change has a material impact on the financial statements of the firm. Firm means Honest and Associates. Firm has made relevant disclosures in its financial statements and has given proper accounting treatment to this exercise. Okay, so all is done in an appropriate manner. Now, let's go back to the first entity, Messrs. Persistent and Company. Remember, the matter was around the change in method of depreciation, something like this. Yeah, anyways, you'll have to just, go through this. For such a firm, considering the scenario, what should be the ideal audit opinion? In that case, let me just go back. A found firm changed the method of depreciation but has not given retrospective effect. A calculated the difference of depreciation, but firm has stated they don't want to change the financial statements. And if the auditor persists, only then they will like to adjust that in the financial statements, but that will be done in the next financial year. So there is an audit adjustment. So this, let me just put it in a very, very simple manner. There is an audit adjustment. Management is okay with that. Management is saying, yes, I agree. There is an audit adjustment. but we do not want to adjust that in the reporting year. We can do that in the next year. So in this case, how will you report this? Over to you quickly. If let's suppose you happen to be the auditor, how will you report this? Over to you quickly. In this case, if you are the auditor, how will you report this? Means what will be the opinion? Over to you quickly. As an auditor, what do you do in that case? What is going to be the reporting requirement? Tell me quickly. What happened? Quickly. We discussed about this. Qualified opinion, disclaimer, emphasis of matter, unmodified opinion. What do you do? Tell me, what do you do in this case? No thoughts? All right, so now in the given case, there's an audit adjustment, right? Management has agreed, but if they don't want to incorporate that, okay. So can you say unmodified opinion can be given? Answer is no. Yeah, so there is a misstatement and we are assuming that to be material. So that's why unmodified is not possible. Should you say disclaimer? No, because there's no lack of information. Should you say emphasis of matter? No, because modification has to come. So that's why what will you do? What will you do? Qualified opinion. Correct? Qualified opinion. Yeah. So I think Gokul has the same answer. Very good. Now, in the second scenario, in case of dubious brothers, if you remember, there was a problem related to cash physical, inventory physical. What should be the audit opinion? Quickly. I think this is a very simple one. What should be the audit opinion in this case? If you are the auditor, what will be the reporting requirement? Almas says disclaimer. Meenu says disclaimer. Gokul is asking me, but he's saying disclaimer. Very good. See, in this case, clearly the information which is required. What is that? Physical verification. Procedure which the auditor wants to do. Management is refusing that. And that is not limited to cash, that is also for stock. Okay, both the items are very critical, and also considering the nature of the business, this can have a huge impact on the financial statements as a whole. So that's why qualification will not be appropriate. Disclaimer seems to be more appropriate. Okay. Third, according to you, in the third entity, Honest and Associates, okay, wherein the company changed the valuation for stock, what would be the appropriate course? What would be the course of action? Qualified opinion, adverse opinion, disclaimer, or emphasis of matter? I think in this case, modification is not required clearly. Yes or no? Modification is not required. So that's why emphasis seems to be the only option. Fourth, when the auditor, after the conclusion of audit exercise, is of the opinion that there are material misstatements in the financial statements, but those are not pervasive. In such a case, what should the auditor do? I think it is very, very simple. We have discussed this quite a lot. What should the auditor do? everyone should answer this. Tanu says C. Almaz says qualified. Shreya says qualified. What about others? Quickly, what type of opinion should be given? I think it's quite clear. So there is a material misstatement, but not pervasive. So is it because of lack of information? No. That's why you're saying there's a material misstatement. It's not a possible error. Yeah. So the opinion will be qualified. Correct? Yeah. So it has to be qualified opinion. Clear? I think Gokul, Priyanshi, they have the same answer. Very good. Fifth one. When the auditor, see, please don't go by the solution which is given. Okay. Just try to apply your thoughts and accordingly answer. When the auditor concludes that the financial statements are prepared in all material respects in accordance with applicable financial reporting framework, what type of opinion should be given? Modified, qualified, disclaimer, or clean, means unmodified. Almaz, Shreya, they are saying unmodified. I think very, very simple. Yeah, it has to be unmodified. Correct? Simple one. Simple one. Yes or no? Yeah. Okay, so now what we can do is we can just quickly look at the other reporting requirements. Now, see, now we are moving back to the audit report. In the audit report, there was a section on other legal reporting requirements. Therein, we discussed that as per the requirements of Companies Act, depending on the applicability, companies may have to, or the auditor may have to report on the IFC, which is called as ICFR, Internal Controls over Financial Reporting, a report on the same. And on certain matters which is required by CARO. And we discussed that it's in the form of a checklist. Okay, so there are some matters over which the auditor is required to comment upon. Now, let's try to understand the applicability of the CARO. So where does this CARO apply? It shall apply to every company except banking company, insurance company, Section 8 company, one-person company, small company. Okay, all of these companies are the one where CARO doesn't apply. Or private company which is not a subsidiary or holding company having paid up share capital reserves not more than 1 crore as at the balance sheet date and total borrowings exceeding 1 crore. Okay, and which does not have total turnover exceeding 10 crore. Yeah, to these categories of companies, CARO doesn't apply. Means for these companies, auditor will not be required to report on CARO. Otherwise, auditor will have to report on CARO. Now, what is CARO? What are those various points over which auditor is required to report on? How are those required to be reported? So I think that is one part we can look at through one actual audit report. Okay, so that's why what we will do is we will get on to one audit report. So now let me just open the audit report. Just give me a minute. Okay, so I'll just go back to the same audit report that we were discussing. And in this report, we will continue on these requirements as well. Fine. Though we have just flipped through these two requirements when we were just going through the audit report, but now we will also look at the pointers as to what all points will be covered. Priyanshi is asking, sir, adverse means unmodified? No, adverse means modified. Okay, modified when the misstatement is material and pervasive. Okay, now let me just go down. Let me just go to that relevant section. Okay, so now this is the section which you remember we discussed. Remember? Yeah. A report on other legal and regulatory requirements. In this case, this first part talks about CARO. Now, in relation to CARO, what did the auditor do? Auditor understands that this CARO is a checklist and this requires auditor to report on various matters. Matters means various areas. So there's not one area. So if the auditor will include all of those points here, so it will become quite hodgepodge in the main audit report itself. So this report, if you remember, we discussed, is also very popularly called as main audit report. So that's why what the auditor does is auditor creates an annexure to this report. Annexure means that will also be a part of this report, but that will come out separately. So this annexure is what? This is about CARO. So auditor will specify that why this CARO is required. Okay. And where is this CARO given in the annexure? And in the annexure, auditor will give the reference of this section of the main audit report, including the para number, so that any user who will read that report or who wants to read this annexure, so this linkage can always be established easily. Yeah, so that's the objective. Further, if we go down, okay, so let me just sort of revisit both the requirements. If you go down in the same section, okay, so we are not moving on to any other section. So we are on the same section. Report on other legal and regulatory requirements. If you go down on this, we discussed that section 143, okay, so this section 143 requires auditor to report on adequacy of financial controls, whether the financial controls are operating in an effective manner or not. Okay. Here again, because it's a full-blown report in relation to the internal financial control. So that's why if the auditor will include here, so this will become quite confusing. Yeah, so this may not look appropriate. So that's why here again, auditor will give a reference of the annexure. In that annexure, such a report is included. Correct? In a similar manner, the way the annexure is given for CARO. So now, let's quickly flip through both of these reports and then we'll come back to CARO to discuss all of those requirements in detail. So let me just go to annexure B first. So in annexure B, when you have a report on IFC, so what is it that the auditor is doing? Auditor is giving opinion. Now this opinion is specific to the internal controls. And in this report on IFC, all of the sections will come. Opinion will be there, management's responsibility, auditor's responsibility will be captured. Okay. What are these requirements of internal financial controls in relation to the financial statements. This section is included. If there are some inherent limitations of internal financial controls, that will also be explained, and this part of the report or this annexure of the report will also be signed off in the same manner the way main audit report is required to be signed off. Okay, then coming back to this annexure A. This annexure A is about CARO. Yeah, so this is what you call as CARO report. Now, in this CARO report, there are various areas. For all of those areas, what do you need to do? For all of those areas, you need to comment. So what we will do is we'll go through these areas and we'll try to understand as to what is it that the auditor is required to comment upon. Now, in this case, please remember, it's a checklist. And this checklist is required on the basis of the relevant section of the Companies Act, or you can say relevant provision or relevant order, relevant para of CARO. Yeah, so that's why there is an order in which all of these pointers will move. For example, when you look at this point 1, okay, so this point 1 talks about PPE. After that, next point that you look at, that will talk about inventory. Okay, now one should not change the order of all of these. So auditor should not think that in relation to all of these points, I need to just answer. So that's why I can just maybe answer inventory first or comment upon inventory first and then PP, depending on some of the administrative convenience which he may be having. If at all, he thinks that. Why? Because in such a case, all of these clauses, okay, they will not move in an order. And if you look at all of these clauses, what are these? These are the clauses of that relevant order. Yeah. So in a very simple manner, we can say that there is an order which is required to be followed here. So this has to move in that order, right? Now, the first point talks about PPE. Auditor is required to comment upon whether the company is maintaining proper records, quantitative details, location of PPE, including intangible assets. So where will the auditor get to know about this from? From the document of the company fixed assets register, wherein all of these particulars are covered. So does it mean he'll only check that register? And is that a hard copy or soft copy? It could be anything. But the important point is that such a register is one of the documents and that is also required to be checked. Okay, then the point also covers physical verification of PPE. Okay, so if the management has done that or not, what is the program of the management in relation to physical verification? Okay, so now physical verification, unlike inventory, is not required to be done every year. So the management can always have a plan. Okay, it can be done in a phased manner, means every 3 years or every 4 years. Or maybe if the size of the company is very big, so they can just plan that one portion they will do in first year, or maybe one category, or maybe few locations in first year, second part in second year, and that's how you can always break it down so that within that period all the items get covered. Okay, so the auditor is commenting upon that. Yeah, so in this case, auditor is saying company has a regular program of physical verification. Yeah, wherein these are verified in a phased manner over a period of 3 years. Then he says, in accordance with the program, certain PPE were verified. In our opinion, this periodicity of physical verification is reasonable with regard to the size and nature of its assets. No material discrepancies were noticed. Okay, next. As regards the title deed, which will be in relation to the land or building, okay, whether those title deeds are free or not. If there is any problem, if there are any title deeds which are not there in the name of the company, so you need to list it down. Okay. Next, if at all company has done a revaluation of PPE, intangible assets, so that is also required to be specified. Yeah. If the company is holding any Benami property, so that is also required to be specified. So this was in relation to PP. Next, on inventory. Now the auditor is required to comment upon inventory, whether the inventory was physically verified or not. And there again on the inventory, what has been the program, if the physical verification was done, there were some discrepancies or not. Okay, yeah. And whether the company has obtained some working capital limits wherein some of these items of inventories have been sort of covered. Yeah. Next, whether during the year company has made investments, granted loans or advances, unsecured to other parties, for which the information is required to be provided, if at all those are given. Yeah. So now once again, if you look at some of these areas, these are considered to be important. Now, during a statutory audit, if let's suppose CARO is not applicable to a company, let's assume, okay, and in some of the companies we understand CARO is not applicable. So does it mean that auditor will not be checking the PPE the way CARO requires? Auditor may not be checking some of these loans advances the way it is required to be covered by CARO? The answer is no. Auditor will still be doing that. Why? Because these audit procedures are not being performed just because CARO is saying that. They would anyways be performed. But over here, law has a specific requirement for the auditor to comment upon that. Understood? Yeah. So that is why it is getting specifically reported here. Clear? Yeah. So that's why there is a specific reporting here. Now in this case, if the company has given unsecured loans, unsecured advances in the nature of loans to parties other than subsidiaries, so that is required to be listed down. So there's a format which needs to be then covered. Okay, so in the audit report, auditor will have to give this information. So it's not the management information, please remember, because it's a part of audit report. So this is the information provided by the auditor. Okay, now this way, a lot of points as around the loans advances are required to be captured. Next, fourth. Now in this fourth point, if the company has given any loans, provided any guarantee as per the requirements of section 185. So again, depending on the specific requirements of the Companies Act, you need to check. Fifth, if the company has accepted any deposits or amounts which are deemed to be deposits from public, okay, so that needs to be commented upon. Now in some of the cases, some of these clauses may not be applicable on the company. Yes or no? Yeah. So to say that each and every requirement will be applicable may not be right. Some of these requirements may not be applicable on the company. So in such a case, what will the auditor do? Can the auditor remove that clause from this CARO reporting? The answer is no. See, all of these points are required to be covered. Why? Because it's a kind of checklist. So when you fill a checklist, whether it is a yes, no, not applicable, this is how you need to comment upon. If there is a section or part or a question which is not applicable, so do you delete that question? Tell me, do you delete that question? Tell me quickly. Do you delete that? No, you don't delete that. Yeah. Instead, what do? You will say not applicable. So the same goes over here. In this case, let's read this fifth para. Company has not accepted any deposits, amounts which are deemed to be deposits from public. Accordingly, clause 3, subclause 5th of the order means CARO is not applicable. So that's how the auditor will have to comment. Okay. Next is in respect of maintenance of cost records. Now, in this case, this is not applicable. So that's why auditor has specified this is not applicable. If that is applicable, auditor will specify that yes, company has been maintaining this. Now, this point number 7, again, a very, very important area in case of audit. And generally, for this, a lot of requirements are in place. Now, this talks about statutory dues. Okay. Now, in this case, auditor is required to comment upon undisputed statutory dues, whether the company has been depositing them on time or not. Okay. So now the auditor says that all of these dues, PF, ESI, income tax, company has been regularly depositing them with appropriate authorities. Means company is regular in doing that. Yeah. Further, if there are statutory dues which have not been deposited by the company on account of any dispute, then such liabilities, such dues are required to be put down. So in this case, some of these dues have been put down. So they are saying, what was the relevant statute? Income tax. Nature of due? Income tax. Amount involved? For which assessment year? Okay, or what was the matter? Which forum where it was pending? And if there are any remarks. So this information is required to be included. Yeah. And this will have to be included for all the years. So this is not for the year. Okay, anything which is outstanding up to the balance sheet date will have to be captured here. So can you see this? These are the financial statements for 23-24. Audit report is for 23-24. But you see all of these dues outstanding for so many years. So all of those information will have to be included here. Yeah. And this will continue here on if this remains like this. Clear? Clear? Next. If there are some unrecorded income which are there in the financial statements, if the company has defaulted in repayment of loans or borrowings, yeah, if the company has been a willful defaulter by any bank, so that's been the declaration. Okay, so those sort of reportings are also required to be captured here. Idea is what? That because these are critical areas, these are critical points. So any sort of information which is in relation to companies in relation to any of these matters, so that should be brought to the knowledge of the users of the financial statements. Okay. Then next point. if the company has raised any money by way of IPO or further public offer. Now, in this case, company has not raised that, so that's why they are saying this clause is not applicable. Okay. If the company has made any preferential allotment, private placement, or through fully or partly convertible debentures, again, the company didn't do that, so that's why they're saying it's not applicable. Yeah. Next. Next point is again very, very important. Talks about any fraud which has been committed by the company or which has been committed on the company. Okay, so now you may be thinking, but sir, if there is any fraud, so will that be not be reported in the main audit report? Don't we have some reporting implications to the government or any of the authorities? Of course, those will remain. Despite that, CARO specifically requires such reporting under this clause as well. Okay, yeah. So in addition to any other reporting which the company may be doing, such reporting will also be required to be done under CARO. Yeah. Okay. Next. Next is in relation to NBFCs which are in the nature of Nidhi company. So they are saying if the company is a Nidhi company, so this is a specific type of, you can say, NBFC. So the given company is not a Nidhi company, but the auditor needs to analyze it, and that's how auditor is reporting upon that. Okay, then the auditor is required to comment upon some of the requirements in relation to the related party transactions. Again, a very, very important area. Yeah, whether those are in compliance with the relevant regulatory requirements or not. So in the given case, auditor says transactions with related parties are in compliance with the requirements of the Companies Act. Details of such related party transactions have been disclosed in the financial statements. Obviously, in the financial statements, there is a separate disclosure for related party transactions. Yeah, so therein it has been included. Correct. Next. Now, next part is about the internal audit system. Auditor is required to comment if the company has an internal audit system. Now, once again, internal audit is not applicable for each and every company. There's a criteria. Okay. If the criteria is there, if the company falls within its purview, then the reporting is required to be done, whether such internal audit system is incommensurate with the size and nature of its business or not. Further, auditor will also say we have considered the internal audit reports. Yeah, because any of such internal audit reports may contain some matters which may have an impact on the financial reporting also. So auditor is required to consider that. Yes or no? Auditor is required to consider that as to whether it is having any such impact on the financial statements. Yeah, so auditor is anyways required to address all of those points in relation to its audit. Yeah, so that can't really be ignored by the auditor, which is covered by the auditor in this scenario. Okay, next. Next is about the non-cash transactions. So if there are any transactions with directors, persons, okay, which are specified under the Companies Act. Next is in respect of our NBFC. So there is a criteria as per this RBI Act, which specifies that under what situation a company may become NBFC, which is specified under Section 144, Section 45 IA. Okay, and if that criteria is met, then the company is required to get registered as NBFC. Okay, so the auditor needs to check whether the company is doing activities of NBFC or not, whether the company is getting into the transactions of NBFCs or not. Because if they will meet the criteria of NBFC, they need to get registered as NBFC. Yeah, so that is something the companies need to look at. And the auditor in the given case is saying, no, the company is not required to get registered as NBFC. Yeah, and that's why some of these requirements related to NBFC is not applicable to the company. Okay, now, if let's suppose company has been loss making, they have been incurring cash losses in the past years. So the auditor is required to report upon that. In the given case, it's not cash loss. Okay, if the statutory auditors have resigned during the year, that reporting is also required to be covered. Okay, yeah, so that reporting is also required to be covered in this case. Next, on the basis of some financial ratios, aging, expected dates of realization of financial assets. Financial assets are like debtors. Okay. Our knowledge of board of directors, management plans, means the discussions the auditor will do with the board of directors, discussions the auditor will do with the management as regards their plans. Auditor is required to check if there is any material uncertainty. Okay, material uncertainty that the company is not capable of meeting its liabilities. Remember that material uncertainty, remember that sort of going concern. Okay, so something on those lines, auditor is required to do an evaluation and report on this. Yeah. Next is around the CSR. So in relation to the CSR, if there are some unspent amounts, those are required to be reported upon. Yeah. Okay. So now if you look at majority of these points, in most of the cases, you would have understood that anyways during the course of audit, all of these points would have been addressed by the auditor. But these are still specifically required to be covered by the auditor in this particular section, if at all this is applicable to the company. Okay. Yeah. All right. So I think there's a point. Mr. Gokuls is asking, is it exact in crores? I could understand what is your. So if you are asking about the numbers reported by the company in the financial statements, I'm not sure in what context you are asking this. So if you are asking about the numbers, so that will depend on the financial statements, okay, on the requirement that the company will have. Okay, varies from company to company. Yeah. Great. All right. So I think this is it that we had on the audit report. Very, very important area. Of course, we discussed that theoretically this is very important for you for examination, but practically also this is very, very important. So that's why, because we are now through with this, so just make sure that you revise this. Okay. And we can just now conclude our discussion. Thanks everyone for your time and for this wonderful participation once again.
Thank you, Achal sir. And students, today we have concluded the chapter number 8, audit report. The weightage of this chapter is 8% to 12%. So I hope you have made your handwritten notes and you are practicing your questions. Okay, for practice purpose, you can refer study material in which you will find questions on test your understanding, and you will find some question under the head theoretical questions. Okay, along with that, you have model test paper booklet from which you will find plenty of questions for practice. You can also practice previous year RTP. So practice as much as question you can. And if you still have any doubt, Board of Studies is always there to help you out. Your next class is scheduled on 14th of May, in which we will start chapter number 9, special features of audit of different types of entities. So before coming to that class, revise the syllabus covered till now, because you have plenty of time. Okay, the next class is on 14th of May, Wednesday. So, and one more information, students. Today at 7:30 p.m., Honorable President Sir of ICAI will address students will address students a session named ICAI stands with nation. Okay, so do join that session. And some of you were asking that since your class is scheduled at 6 p.m. of paper 6A, so how will you join that session? So yeah, that class will get over before the beginning of the session. Okay, before 7:30, the class will get over. So do join that session, and we will see you in the next class. Thank you. Yes, Altaf, you can.